when should I convert, right? When should you convert from the traditional to a Roth? And when should you not, right? And if you do convert, how much should you convert? Hi, Michael Reese here. We've been getting a lot of questions here in the office about when should you do a Roth conversion? When do you not do a Roth conversion? So I thought we could spend some time today to really dive in and explore that a little bit. What is a Roth conversion and why is it so attractive to people, right? So think about it this way. Let's imagine here you have your statement, and this is your it's a 401k statement, an IRA statement, you know, something like that. And you look at your statement, it says, you know, the John Smith 401k or Jane Smith 401k or IRA, and you look at the account balance, you're like, wow, look at that. I've got $1 million in my 401k or my IRA, right? And you're like, oh, yay, I'm doing great. I've saved $1 million. And by the way, if you saved $1 million, that is great. And you may have saved more, you may have saved less, that's fine. One of the biggest mistakes that we see people making is when you look at your account statement, like we have up there on the screen, you think to yourself, okay, I have $1 million. Well, do you? Something is worth what you can sell it for and then put cash in your pocket. Now, if you had a home, let's say you had $1 million home, right? So let's compare this to a house. Yes, I know you could draw a house that looked better than that by the time you were in 3rd grade, but not my strength, right? The house was worth $1 million. Now, what if you had a mortgage on the house and the mortgage was $400,000? If you sell that house, how much money do you put in your pocket? Well, obviously, you're going to put in the difference, which is $600,000. So what is that house worth to you? Is it worth the $1 million that it's valued at? Or is it worth the $600,000 that you would put in your pocket? You sell the house, it's worth $600,000. That's the value of that asset to you when all is said and done. How does that apply to a 401k or an IRA? What did we say? It's worth $1 million because that's what's on your statement. Is it really all your money? What if you cashed out that 401k and you put the balance, the money in your pocket? How much would you put in your pocket? I live in Texas, so we don't have to worry about state income tax. Like if you live in California or something, you certainly have to worry about state income tax. But if you try to cash out a 401k, what's going to happen? The IRS, you know what? I don't really like the IRS in green because green is usually good. Anyway, the IRS, they're going to have their hand out. They're going to say, wait a minute, part of that $1 million up there, part of that is ours. How much do you have to give to them? Well, it depends on your tax brackets and all of that. But let's imagine, for the sake of this discussion, that you have to give them $350,000. What does that tell you? What is the real value of your $1 million 401k or your $1 million IRA? It's really about $650. That's what it's worth. Step number 1, when you look at your accounts, you need to recognize that when you have an IRA, a 401k, a 403b, a 457, these traditional accounts, it's not John Smith account or Jane Smith, right? It's not an account. You are not the only owner of that account. It's John Smith or Jane Smith and IRS's account. So if you have a 401k, it's Jane Smith and IRS's 401k. John Smith and IRS's 401k. You have a joint owner. Here's how their ownership share works. The bigger the pot of money, as your money gets bigger, their percentage increases. So the more you have, the more their percentage goes. It's kind of like this. Here is your 401k or your IRA. And here's what happens. Maybe if you have $100,000 in your 401k, we might say, wow, the IRS's share is pretty small. Maybe it's like 15%, right? But what if your 100,000 grows to 500? Uh-oh, their share got bigger. Now it's maybe 25%. And now your IRA is worth $1 million. Uh-oh, now their share is probably 35%. Oh, you've done a wonderful job. Your IRA is worth $3 million. Well, now their share is, maybe between state income tax and IRS, federal tax, and what they want to do with taxes here coming up in the near future, it might be as much as, 45% or 50% or even higher. In other words, the bigger this account gets, your share goes down in value and the IRS's share goes up. Wait a minute, Mike, wait a minute. I seem to remember being told that it's the opposite, that, the benefits to having money in a 401k or an IRA is that as your money grows, right? Oh, my account's getting bigger. Say, hey, I'm making money on what? I'm making money on the IRS's money here. It's good for me. That is not true. It is the exact opposite. That is not true. That is a lie. When you're in an environment where the more money you have, the tax rates go up, this over here is what's happening. You're not making money on the IRS, they're making money on you. What is the big benefit of a Roth IRA, right? You're Jane Smith and IRS's 401k, right? Let's say that's what we have here. Jane says, naturally, she says, I don't like this. I don't like how when I grow my money, the IRS gets a bigger share. I don't like that. I also don't like, she might say, I don't like the fact that, I'm putting my account values in the hands of Washington, D.C. politicians, right? I don't want these politicians to have control over how much of my 401k they can get their hands on. How do you protect yourself from both rising tax, this situation where the more money on the left, the more money you have, the bigger the IRS's share, and we don't want to deal with these politicians. I want to immunize. You want to immunize yourself from those goofballs in Washington, D.C. That's where Roth conversions come into play, because with a Roth conversion, basically what you're doing is you're saying, here's your 401k or your IRA. It's got $1 million in it. You're basically saying, I know that it's not all my money. I know that I'm 100% exposed to tax increases. I know that as it gets bigger, the IRS is going to get a bigger share already. They're making money on me. I don't like that. So what you do is you say, I'm going to transfer this money into a Roth account. Now, if you see the word Roth, whether it's a Roth 401k, a Roth IRA, anything like that, if you see the word Roth, then that means 100% of the money in here is yours. 0% is IRS's, right? So we kick them out of our lives. We get rid of them. And so it's natural that if you pay attention to what's going on, you say, yeah, I would like to do this. Before this account grows any bigger and the IRS's share gets even bigger, I want to get rid of them. You essentially buy them out. It's like a business. You buy them out. You say, okay, I've got $1 million. I'm going to go ahead. I'm going to convert the entire $1 million to a Roth over here, right? And if the IRS's share, here, let's make this red. If the IRS's share of your account is $350,000, you say to them, hey, IRS, take it. You take your share. I'll take my share over here, $650, right? I'll take mine, you take yours. We're going to go our separate ways. We're going to get divorced, right? Get out of my life for the rest of my life. And every dollar you grow here is 100% yours now. And it doesn't matter what the people in DC do. It doesn't matter what politicians do. It doesn't matter what tax rates do. That's your money now. It's your money for you, for your family. And so all that growth is all yours. Now, yes, they're in DC, they're now talking about, hey, if you've got more than $10 million in these IRAs, they're going to start making you do distributions at certain times, but they're still tax-free distributions, and that's okay. I'm just saying they're going to want to mess with that a little bit, but the bottom line is it's all your money, and that's what matters. So a lot of times people, they struggle with that number. They say, I don't want to give that money to the IRS. I mean, who wants to write a check to the IRS for $350,000? I would just argue, I would say, well, what do you mean? It's not your money anyway. You're giving them, it's like, forget about, what if this were an account with you and your best friend, Bob? And for reasons that we described earlier, you want to get Bob out of this partnership. You know, because his share goes up and you can't control it and all that kind of jazz. You do all the work, but his share gets bigger. It's like, that makes no sense. Bob, you take $350, I'll take $650, we'll go our separate ways. It's no big deal. The problem is, Bob's name is the IRS and it seems to offend us, right? But that's just not logical. Now, here's the cool thing. You do not have to do this all at once. You can break it up and do it in bits and pieces. So, this brings up the question, let's go to the next page here, brings up the question, when should I convert, right? When should you convert from the traditional to a Roth, and when should you not, right? And if you do convert, how much should you convert? Now, before I answer this, really important, this is going to be red. This is going to be red letter language. Remember this. Everyone's tax situation is what? You know the word I'm looking for here. Everybody is different. You're all different. So if you're watching this, do not go out and do a bunch of conversions or do anything without first talking to a tax expert, someone who understands the tax code, who can put your unique situation, all your unique numbers into some software that can tell you the outcomes of doing any kind of Roth conversion. By the way, if you want to talk to us and get our opinion, I think in the comment section below the video, there's, I think, information in there on how to contact us, right? So you can look that up. How do you figure this out? Like, when do you know how much to convert? And I'm going to give you, this is going to be a rule of thumb, right? Rule of thumb. And what does a rule of thumb mean? It means that this is a guideline. It is not, and I repeat, it is not a recommendation. Because again, all of our situations are different. You want to make sure you are filling up the 24% federal tax bracket. Now, for a married couple, that means you can have AGI around 350-ish. And for a single person, it's I think roughly half of that. Here we've got husband and wife, and their income combined is $150,000. The 24% tax bracket, though, goes up to $350,000. So one of the things that we would consider doing a Roth conversion of the difference. They might say, wow, that gives us roughly $200,000 of room for a conversion. And they're going to have to pay tax on that, right? They're going to have to pay the IRS the tax on that $200,000. This couple, they go talk to their tax advisor or they call us and they learn, yes, this is indeed the number that makes sense for us this year. And by the way, this tax bracket here, that's only good through 2025. Starting in 2026, you need to know this, in 2026, the same married couple, they're going to be at 25% tax bracket once they get to about $100,000 of income. So you've got a window for the next 4 years here, right? 2020, from today through 2025 to actually, take advantage of this bigger number up here. So anyway, let's say this couple, they decide, yes, we want to convert 200,000. They are under the age of, here's a red letter age, 59 and 1/2. If you are younger than 59 and 1/2, whatever that tax obligation is, you have to write a check. That means you have to have money outside of your IRA to write the check. So if this tax bill is $50,000, you got to write a check for 50 grand to the IRS. And you will convert in the new Roth IRA, you'll have the full 200,000 in the new Roth IRA. Maybe we're over here. Maybe when they started, they have 1 million in the IRA. Now they're going to have in the IRA 800,000. And in the Roth IRA, they'll have the other 200,000, right? That's what's happening here. And they've got to write a check to the IRS for whatever the tax amount is. Say it's 50,000, they got to write a check. Well, what if we are older than 59 and 1/2? What if we're older? Same situation, $1 million in the IRA. They're going to convert the same 200,000, leaving 800 in the IRA. But here's an interesting thing. They could, if you're over 59 and 1/2, in the Roth IRA, they could say, put our share, the 150 in the Roth IRA, we are going to withhold the 50,000 in tax so that you don't have to write a check. So if you're over 59 and 1/2, you can utilize that fun little trick. When should you convert? How much should you convert? When should you not convert? If you're below the 24% bracket, generally fill it up with conversions. Not true for everybody, because again, you might be in a situation where you're lower than that tax bracket today, and you're going to be in lower brackets for the rest of your life. If that's the case, maybe not. Maybe you shouldn't convert. But general, for most people, different for everyone, for most people, this is kind of a general rule of thumb. What if you're higher than the 24% bracket? Your income is already putting you in the 32% bracket and above. Don't convert. Generally, you're going to say, I'm not going to convert now. I'll convert later after I'm done working and my income goes down. But that's going to bring up a third special situation. You are higher than the 24% bracket today, and on top of that, you're likely going to stay there. For whatever reason, the way you're a high income earner, and you're going to have, for whatever reason, a lot of income in retirement as well. You're always going to be above these higher tax brackets. You're always going to be above that 24%. You're always going to be in the 30% something brackets. If that's the case, then in many cases, it makes sense to convert 100% of your IRA or 401k now. Over time, tax brackets are only going to get higher. You might as well, right now, tax brackets are probably the lowest that they're ever going to be for the rest of your life. You might as well take advantage of it, get that money out of the scenario where you're going to be subject to all these higher tax brackets over time. Get it out of there, immunize yourself, and just say, hey, yes, I got to give a bunch of it to the IRS. So what? I'm going to do it anyway. Now I'm going to give you one last rule of thumb, number 4. If your 401k or your IRA is going to be over $1 million in retirement, if you're in that situation, you need to look at conversion schedules. Because even if you're in a low tax bracket now, let's say you're up here, you're less than the 24% tax bracket, right up there. And you're always going to be less than 24%. You're like, I'm always going to be really low, so I'm always going to be in a lower bracket. But your accounts are worth over $1 million. Guess what? You think you're going to always be in a lower bracket, but the minute you hit age 72 and you've got required minimum distributions, it's really easy for those distributions to put you in higher tax brackets, especially when you get in late 70s and early 80s. So that's a situation where even if you're in low tax brackets, you want to look at converting anyway. Whew! I know it's not simple, is it? Everybody's different. Don't do anything without talking to an expert, someone who understands the tax code. Talk to your CPA, talk to your tax professional before you do anything. If you want, you can always talk to us, but let's make sure that, bottom line, for a lot of reasons up here that we talked about, we said what? We want to get the IRS out of our lives. We want to get Washington politicians out of our lives, right? We want it to be your money, not the IRS's money. We do that through Roth Conversions. But what's the exact right approach for you? Kind of depends on the situation, right? That's as best as I can clear this up for you. I hope you found this helpful. We'll talk to you again soon.